Welcome to the Options 101 course. If you're new here and never met me before, my name is Jessica Inskip. I'm the Director of Education and Product here at OptionsPlay. Honestly, wear a lot of hats here at OptionsPlay, but essentially that means that I work a lot on the education aspect and make sure that we bridge education and application, something that's difficult to do when you're dealing with the complex world of options. And that's where we work with a lot of brokerage firms in order to bring those things to life. So you actually see a lot of really cool tools of ours implemented in a ton of brokerage firms, and we're the brains behind that. And yes, you will get a copy of this slide deck when we are complete. All right, so today is an Options 101 crash course. We're basically going to take about 4 presentations that take normally about 4 hours to go through, but condense it in a easy to understand manner. It is going to be a lot of information, but it's in a succinct and very linear format, so it will build across the whole experience, essentially. Disclaimer. As always, sometimes we talk about securities, we bring up the OptionsPlay tool. You may ask about the market. I may answer purely for informational and educational purposes only. This is not individual planning, tax, legal, or investment advice. Financial planning and personal finance is very personal, and this is not that. And there's my job. And if you have never attended any of OptionsPlay's education sessions, know that at OptionsPlay, it's our mission to just empower you to trade sustainably. That starts with investing in your education, understanding options. Options can be so complex. And I remember when I personally first learned how to trade options, was almost, say, about 12 years ago. And it was actually when I was on an active trader desk over at Fidelity, and they literally put you in a room and there are 30 people around you. Clients would give you 4-legged options trades with restrictions, and you had to calculate margin manually. And you had to be able to do that within 90 seconds, and they'd put you on the spot. But that's how I learned. It was a very intense environment. It's actually the first female in that environment, but I'm thankful for that type of environment because it just taught me options really well. But it was a good group that gave me those light bulb moments. And so a lot of why education that you see from us and what I bring to OptionsPlay is actually learned from there. But I think that's the importance that you need to understand to empower you to trade confidently, is that foundational aspect of understanding how options work. And we're going to crash course you with that today. All right. So moving on, what is an option? Well, an option is simply a contract between a buyer and a seller. You might have seen this slide. If you have, give me a thumbs up. If not, I will make sure that I'll explain it a little more. But nonetheless, a contract between a buyer and a seller. Within every contract, there is someone who is paying for that contract. They are the ones that can execute upon that contract. They own the rights because they purchased it. There is a seller who is obligated to fulfill the other side of that contract. So the buyer pays a premium. In exchange for that premium, they have execution rights. The seller receives that premium. This is all upfront, forms of credit or debits, and they have the obligation to fulfill the other side. The way that we love to describe that is the buyer is the driver, the seller is the passenger, as in you have to pay attention to your surroundings. We're going to talk about exercise and assignment. That, because the execution rights literally are by the person who purchased the contract, that is important to note as we move on to this. So it's issued as a call or a put. A call simply means that it contains the right to buy. Put means that it contains the right to sell. So in this example, this contract represents 100 shares of ABC at $100 per share, executable at any time through the expiration period, which is May 24th, 2023. If it was a call, then it would contain the right to buy. The buyer would pay for the right to buy 100 shares of ABC at $100 per share. They could execute upon that on any time through the expiration period, and the seller would be required to sell them the shares at that price. And it's the buyer's discretion. They're in the driver's seat. We'll build on this. So if that was confusing, don't worry. We're going to expand much more. So let's talk about the anatomy of an option. So whenever we have a contract, we are asking questions and essentially answering them. What quantity are we agreeing on? What product are we agreeing on? What's the price and what's the time frame? That's the way that we break down the jargon. The quantity is simply the contract amount. One contract generally represents 100 shares. The product is simply the underlying security. It can be a stock, ETP. I say ETP, which stands for exchange traded product, because that covers an ETF, exchange traded fund, and an ETN, exchange traded note. Index or currency, even a commodity. The price is just the strike price. What's that agreed upon price? It's priced per share. So whenever we're looking at one contract per share, multiply it times 100. That's where that lovely little algebra equation comes in. And then the time frame, simply the expiration date. What's fun is it's normally on Fridays, and options now have just, as technology has progressed, as have the security issuance. Normally, it actually started when options expired once a month, and we had that third Friday of every month was the options expiration cycle. And then it's actually a test on a question on one of those series exams as to when those cycles are. But then it moved to every Friday. Then we had, so our weekly options, we've got our monthly options, we have quarterly options. Those what those represent, if you've ever seen those on an options chain. But now we've got options that expire every single day just due to technology and as these newer products are coming to life. And we have the popularity now of 0 days until expiration options. Fun little fact, it's not that the OCC is creating options that expire on a daily basis. It's just weekly options that are expiring every single day. Nonetheless, so back to that example, this would be one ABC 100, March 24th. Let's just assume that's 30 days from now. That means that this would represent the 100 shares of ABC stock at $100 per share, expiring on March 24th. If it was issued as a call, the right to buy, put, the right to sell. The option can be exercised, which means you can execute upon those terms. So in the case of the call, I could say, you know what? ABC is at $110 per share. I own the right to buy it at $100 per share. Let me go ahead and execute upon those terms, and I will take ownership physically. It's called physically settled, of owning 100 shares of ABC stock in your account. Most brokerage firms, they require you to call in to do that. Some do it online. Not a lot of people actually exercise their contracts. We've got some statistics that we'll share in a moment. Puts, just the inverse, the right to sell. It can expire. That may be your goal. Options are a beauty in the fact that they can be profitable in a bull, bear, or even neutral market, but that's because you can layer them together, and there are just numerous strategies that you can come up with. But in order to get to that process, you need to have these foundational aspects that we're going to cover today. Or they could be traded on the secondary market, which is normally what occurs. So where we buy it for that premium, and then we sell to close it for that premium, or the inverse, depending on your strategy. And the premium is simply the price that it's traded for, which is what we're going to break down in a moment. So now I like to start with this. We're going to build on this. If you've attended my favorite Greek session, we start on the basics with this chart, and then we build on this all the way to the Greeks. It's a great way to just put everything together. Literally, we call this a T-chart. If you're ever on a trading floor or in those call centers, even with your major brokerage firms, these are at everyone's desks to help them put together the options puzzle. So the way that it's structured, we put calls on the left-hand side and puts on the right-hand side. Apologize if it's inverse due to the screen. Nonetheless, we put long calls on that upper left-hand side quadrant, and then short calls below that, short puts on the upper right hand, long puts below that. That's the structure of it. The way that we do this is when we're learning, and today we're going to focus, we're going to cover each individual leg, but when you're learning, it's easiest to wrap your head around long calls first. That's a little nugget of information. If you never learned options before, focus on long calls, master long calls. Everything else might get a little muddy, but you can go back to this because everything is essentially a mirror. So when you purchase the call, since I own a call, I own the right to buy the underlying. I pay a premium for that. We know that. Some terminology that I want you to keep in your head every time you see these words. The word long means purchased, call, the right to buy. Short means sold. Again, call the right to buy. The is very important there. The short call is sold for the premium. We receive that up front. You're obligated to fulfill the other side because it's a contract. So the long call holder can execute. They could buy that 100 shares of ABC at $100 per share. Someone has to sell it to them. That happens through the assignment process. So long option holder exercises, short call holder subsequently is assigned. We'll go through how that works too. And that's how the terms are made whole of that contract. Short put is literally just the opposite. For the long put, it's purchased. Long purchase puts the right to sell. So you purchase the right to sell. Since I purchased it, I paid the premium. And the right to sell, I have the execution rights associated with that. The short put, I sold the right to sell. So I receive an upfront premium, but I am obligated to fulfill the other side of that, which is buying. So I'm doing the inverse there. And what you'll notice on the top, you'll find bullish strategies, and on the bottom is bearish strategies. Because if I purchase a call and I have the right to buy, your goal when you are purchasing options is you want them to go up in value as much as possible, increase in value as much as possible. When you have the right to buy something, that means a stock can go to an infinite price. Your long calls have substantial and unlimited profit potential. Short puts, the maximum that you can make on a short option is the premium that you receive. So this is neutral and a slight directional bias. And that's important to understand the Greeks and advanced concepts as we set it. This is a solid foundation to get you there. This is all true on a crisscross and mirrored, so that just focus on the long calls and this will bring absolutely everything together. So long options, you expect a sharp directional move in your desired direction. Short options, you are neutral and have a directional bias. For a put, you are bullish. For a call, as in a short put, you are bullish. Short call, you are bearish. Long calls are bullish. Long puts are bearish. So utilize this. We'll build it. You will see this multiple times throughout today's presentation. And if that makes sense, we'll do what Tony does. Give me a 1 in the chat. I don't know. I like the emojis too, but we'll figure out what we want to put there. Great. Just got to remember what number we're on. All right. So let's talk about different types of stocks and what we can use options for. And now normally we start with this, but I did an inverse with some intent behind that, if you will. So when we're looking at stocks, there are normally 2 types of stocks. There's growth versus income. We can definitely, definitely pull that out to value and blue chip and so many. But primarily, when you are purchasing a stock, there are 2 different categories that you go into. You're looking for capital appreciation, or you have an income view. Those growth stocks, technology always comes to mind. They have those higher PEs. They generally do not pay dividends. There are those that are growth in income, like Apple, that is a growth stock, falls in within technology, but it still also pays a dividend, but it's not its primary focus. Whereas you have something like AT&T, which is definitely more of an income oriented security, because they're notoriously known for always paying their dividend, but not necessarily super high capital appreciation. Because whenever you have an income or either one of these, when you have a profit from those businesses that are essentially a stock, you're either reinvesting it back into that security to innovate and make new products, hence the growth stock, or you're distributing it to your shareholders via a dividend. And of course, there's also stock buybacks and others that we could cover there. But that is the intent normally when we have a stock. When we add an option, it's a derivative of the underlying security. So there's other components that are associated with it. But the beauty of options is they also fall in these 2 categories as well, but so do the stocks. So it's important to have some intent behind the securities that you choose when you're trading options and to understand your goal. So we'll expand on this, but just wanted to start with that as far as stock investors, something you should be familiar with. We got to this point where we want to take it down to options. So the difference between stocks and options, once we're expanding and going from stocks and adding that layer of options to our portfolio, there are some key differences that are very important to note. One, when we have a stock, we have voting rights. You are looking for capital appreciation. You are entitled to that dividend because you own a share, you own a small piece of that company. You can hold it theoretically forever, and it will go up and down in value unless it goes bankrupt. Lots of nuances there. And your price of that underlying security or that stock is influenced by earnings, revenue, technical, fundamental. It normally requires a lot more capital to buy that stock. Whereas options, you have a contractual right to be able to buy that stock, but you don't own it, which means if you hold a long call that has the right to buy shares, you're not entitled to a dividend because you don't own it prior to the X date, and you don't have any voting rights. So those are very key differences that are important from the fundamental aspects, but you also can't hold it forever. Options have an expiration date. The price or influence of that options price or premium is derived from the underlying security, which is the stock. But because we're adding an expiration date, that is going to affect the price of the option. If you have more time for it to have more executable value, should be more expensive. We'll talk about that. And implied volatility and interest rates affect the price of option, because we have to talk about the influence of all of these factors. And there is always positive and negatives. We like to refer to these as give and take. Options are also utilized for leverage. It requires less capital, but because there is less capital, there's always, if you have increased risk, there is always increased reward, but there's that payoff profile that's important to discuss. So why investors trade options? We'll go through this one really, really quickly. But speculation, you're taking a directional risk. You've got a defined limited risk. Those are when we're buying options, because the most that you can lose is the amount that you spend when you're buying an option. That's because you own the execution rights. You're in the driver's seat. You can choose if you go left or right or stop at the stop sign. If you're on the passenger seat, you do not have that ability. That's where you're on the income side, because you're selling the option, you receive that upfront premium. Now you're a passenger, but you can be a passenger and set up that premium to create an income portfolio. That can be for the long term, can be for the medium term, can be for the short term. If you attend the Fidelity and the Money sessions, oftentimes I will do cash secured puts and covered calls with a long-term portfolio view, and that's the investor lens that that's taking. And if you think about the growing wealth via compound interest and just even purchasing on automatic investments, passive ETFs, you can do that utilizing something called the wheel strategy with an income approach. There's lots of things that you can do. The third and most common component of options, or other common, not most common, is hedging. You can utilize them because if you purchase a put, it gives you the right to sell something. So you for a moment in time, it's almost like buying insurance for your security. You pay a premium for downside protection, and it's for a certain period of time through the expiration date. You can utilize that for hedging purposes if you're afraid of a downturn. And then at OptionsPlay, we will talk about different hedging strategies, and we tend to have those when the market is a lot more volatile and we perhaps expect a downturn, which we will not talk about hedging today. So real quick, if we have those speculative strategies, I touched on them, some visuals. If you feel that the stocks can go up to an astronomical price, long call, down, long put. So you purchase the right to buy, purchase the right to sell. You see how that goes. Sharp directional is important, up or down. When you purchase an option, you expect a sharp directional move. Those are important. You buy a call, you're bullish. You buy a put, you're bearish. And you own the rights to execute upon the terms of that contract. Income trading. This is where, notice how the arrow went down slightly. That is where you have a slightly directional bias. Now, if you have a covered call, that is a bullish strategy, even though I know I just showed you a short call, and individually that is bearish, but it becomes bullish when you pair it with a stock. And we will talk about that today. It's the only multi-leg option strategy that we will talk about today. But that's a way to add yield to your existing portfolio. You sell a covered call or a cash secured put if you do not own the stock and you're obligated to buy or sell the underlying with those options contracts because you're taking the sell side. So you have the obligation side. And hedging just means that I'm protecting against those downturns. We talked about that. You want to reduce your risk on a position that you have, and it protects profits and reduces risk for a specified period of time. All right, so let's run through options pricing. Let me do a quick check on time. Oh my goodness. Okay. So an options price is made up of a premium, and the premium is made up primarily of intrinsic value and extrinsic value. Intrinsic value just means that executable value. Is it in the money? That's another term. That just means that a contract has executable value. Extrinsic value is made up of time value and implied volatility. Intrinsic value just really means internal factors that affect the option, and extrinsic value is external factors that affect the option. So we'll break that down with the examples that I have on the left. If you have the right to buy ABC at $100 per share, and the stock ABC is moving above your strike price 100, I said 110 earlier, that means that your option has intrinsic value, executable value, because you could execute upon the rights of that contract, buy 100 shares of ABC at $100 per share, immediately sell it at the market at 110. That has to be worth at least $10 per share. It's normally going to be worth that intrinsic value at expiration. So the extrinsic value is a depleting factor, and that's mainly time value and implied volatility. Meaning, if I have an option that expires tomorrow, that is going to have less time value than an option that expires a month from now. And that makes perfect sense because it has more time to have executable value. Therefore, it should be more expensive. So the more time until expiration, the more expensive it's going to be. Implied volatility, a great example is an anticipated earnings announcement, also amplified across the broader markets when we have economic events as of late around interest rates and inflationary concerns. The anticipated earnings announcements, though, are all of those examples. That is a specified date and time. We have an earnings consensus, revenue expectations, and conference calls. We expect the stock to move up or down in either direction. You'd think, oh, I'm going to buy a call because I know I might be bullish on NVIDIA's earnings or whatever, and it's going to go up in value or down in value, whatever your speculative view is. But because of that, market's likelihood and expected movement of the underlying security, the option is going to be at an inflated price. And then post earnings, it deflates because the stock already moved. We know it's going to move, but we just don't know what direction. And since we know it's going to move quite a bit, the option is more expensive. We call that volatility crush with those post earnings events. So important to know what those factors are when we're looking at an option and understanding options, understand the positive and negative factors, understand when a price of option is inflated or deflated, because we can sell or we can buy those options. If we're buying an option, we want it at a deflated price or a price where implied volatility is not high, but we want optimal time value because we're going to buy time and it's going to decay, but we don't have to hold an option until expiration. In fact, you should never hold an option until expiration because when you buy an option, you're buying time. We want to sell to close that time before it completely depletes. And when we're selling an option, you sell time. We want inflated implied volatility, but we also want to have enough time for that time to deplete and close it before it turns into risk. So either way, holding an option until expiration turns into risk. And we can certainly break that down further. Just have a quick example that I ran through. If you have the right to buy something at $100 per share, so this is an ABC option with 30 days until expiration, trading at a premium of $5. If you have the right to buy it at 100 and ABC is at 103, well, we can execute on our rights, buy at 100, sell at the market at 103. Got to be worth at least $3. That's its intrinsic value. Extrinsic value is just the excess. So if the premium's 5, the in the money value or executable value is $3. Excess is the difference, which is 2. 3 + 2 = 5. Yay on math. That's what the premium is comprised of. This is a decaying factor. So this will work in your favor if you are a seller. It will work against you if you are a buyer. All right. So let's talk about each individual option strategy, we're going to go through long equity calls. We'll go through long equity puts. We'll take you through a covered call and a cash secured put. Before I do that, I want to make sure everything is no questions thus far. And if that made sense, go ahead and put a 2 in the chat for me. And the thumbs up. I'm liking the emojis. whichever you prefer. Great. All right. So long equity calls. I've described this example quite a bit, so I'll breeze through this one, but repetition is so important, especially if this is the first time you're learning about options. So this is the way it would look like in a trade ticket. We'd buy to open one ABC call expiring on your chosen expiration date at a strike price of $150 in this example for a premium of $7. That means if I were to put in this trade, I would own the right to buy 100 shares of ABC at $150 per share. I could do it in the case of an equity option at any time through July 8th. Does it make sense for me to do it at any time? No, but I have the right to. And in order to have that right, I paid a premium, in this case, $700 total. My max risk is if ABC does not move at all, because I am buying an option. Therefore, I want a sharp directional move in my directional bias. And since it's a call, I have the right to buy, that bias is upwards. The most I can lose, though, is the premium that I paid because I own the exercise rights. I break even at expiration if ABC moves as much as I paid. That's why we don't want to hold an option till expiration, because the time value is not linear. It starts falling off of a cliff. Thought of a great example of it when I was talking to my son, picking him up from school the other day. He was telling me how he doesn't believe me that time flies by as you get older. And I said, oh no, I'm getting old, because it actually does. And the theta works the same though. As you get closer to expiration, it feels like time is constantly flying by. Theta, or the time decay, works that way. You can see how I just spit out a Greek. This literally prepares you for Greeks. That's why we don't hold an option till expiration. But at expiration, you need the underlying security to move as much as you paid for the option, the right to buy in this case. As soon as it moves above that, that's when you start gaining in value, and you have unlimited gain potential because the stock can theoretically go to an infinite price. But remember, you have an expiration date. So it's important to have a price target in mind, close that option when it hits that price target. We have best practices that we talk about at OptionsPlay, happy to share as well. But that is the gist of a long equity call and how it works. And you'll notice this is why I say sharp directional move, is because you need it to move more than what you paid for the option. So therefore, you are expecting a sharp move because you want it to overcome more than the cost for the right to buy. Make sense? Put a 3 in the chat for me. Okay. Let's go to the other side. Long equity put. Literally, same thing. We just flip it. And I apologize, I failed to explain the profit and loss charts. You see this flat line. Anytime you see a flat line, that tells me limit, and anything that's just going up or down, that's your substantial or bigger. So I can immediately see from this that this is a bearish strategy, because this is the stock going up in value and it's gaining as it goes to the left rather than the right. Some people are more visual than others. That's why we like to have these variations. So same thing with the trade ticket. Buy to open one ABC put expiring 30 days from now at a strike price of 150, paid a premium for 5. That means if I were to execute this trade, I'd own the right to sell 100 shares of ABC at $150 per share at any time for the next 30 days, and I paid $5 for that right. And you might say, wow, this is the same as the previous, but the previous was more expensive. That happens. Sometimes the put side is more expensive than the call side. And that's the way you can utilize options, even for an analytical view, which we cover in other sessions, because people pay more. That implied volatility comes up because you might expect a downturn, or you might be a little more bullish, and you can see the skew. Nonetheless, we pull real prices and normalize them. And that's why you see this sometimes. Same concept. The max risk, because I am in the driver's seat, I can execute upon the terms of this contract is just the amount that I spent and the premium that I paid. In this case is $5. I break even at expiration as long as the underlying security moves as much in my directional bias that I paid for the option, which is $5, so 45. And then I have substantial gain potential because the stock can only go to zero, and I'm going to gain dollar for dollar as it goes down, as in that intrinsic value is kicking in. Let's look at a covered call. So now we're going to go back to the other side of the chain and we're going to flip it around. So in order to create a covered call, remember, if I am selling a call, I've sold the right to buy. In order to cover my obligation, in my obligation to sell, fulfill the other side, I need to own something. So you have to own 100 shares of an optionable stock or ETF. You sell a call option and you use those shares as collateral. It's literally saying, like, you have a home and you have that loan on your home, and if you default on it, you don't have to go and buy another house. You are just going to turn in that house because you already own it. It's covered in that aspect. So you are selling a call, utilizing your shares. You receive a premium in exchange for that obligation to sell that stock at a specified price. Ooh, went too fast. So what that means is this dotted line here represents you owning the stock. It can go up to an infinite value because theoretically it can go increase to a lot, or you have substantial loss potential, or you do have substantial loss potential because when you invest in a security, the most that you can lose is the amount that you spend. And I always get somebody who says, what if I'm on margin? We're talking about cash, not that. So same substantial loss potential. When you sell a call, you actually reduce your break even because you're receiving a premium. So say we received that $5 premium, that would be our max gain, regardless how high the stock would go, because you have capped your upwards potential. That's the give and the take with options in this case. The give is you're getting $5 a premium. So if you purchased 100 shares of ABC at $100 per share, you sold the right to sell at 110 for $2. Well, you've reduced your break even to $98, and you have an obligation to sell at that higher price of 110. So it's a way that you create consistent income. And when you're doing this type of strategy, you have to account for capital appreciation in addition to yield. And that's another way that options traders utilize options, the obligations found within options, to buy and sell stock, a longer term view. Oftentimes, if you've never traded options, you'll either start with those long calls or puts, and then you graduate into the covered calls because this is more consistent and less risk. And that's why it's always level 1 on those options applications. All right. The other side of that is the cash secured put, meaning to cover the obligation found within a put, you just have to have the stock, or excuse me, the cash available to buy the stock. Profit and loss chart looks identical because it is bullish, and the maximum that you can make is the premium that you receive, no matter how high the stock goes, and you retain the same substantial potential as owning the stock because you're obligated to buy it at that strike price. And once you buy it, and it will kick in when it moves adversely. And once you buy it, the most you can lose is the ownership. So has this a similar risk profile to owning the stock? The difference is the upside cap. So you have upside risk. Oftentimes, the first time I talk about a cash secured put, you'll say, why don't I just do this all the time to buy a stock? Well, you don't want to do that on a stock that you think is going to move up directionally super, super high, because this is neutral to a slight directional bias. So in order to create that cash secured put, you have to have the cash ready available to buy the stock. You've got one contract and the right to buy at, or the obligation to buy at $100 per share. You need to have the ability to buy 100 shares at $100 per share. You sell that put option, you utilize the cash as collateral. Literally, your brokerage firm will set that cash aside unless you have a margin, and it's about 25% of that. You receive a premium up front. And then that creates the obligation to buy the stock at that specified price. And that can happen at any time because you're in a passenger seat when we're looking at this type of option strategy. All right. So that's how we would build out this chart specifically. We've added now, so we started with setting it up. Now we're going to add the goals. When we buy options, we are expecting a sharp directional move in our directional bias. So therefore, we want the stock to rally or decline, depending if we're buying a call or a put, more than the premium paid. We establish that. Time is a negative factor if we buy options because it depletes the value of our option, does not work in our favor. These are for long options, and long options profit from sharp movements. So these are your goals. Short options, time decay works in our favor. We sold an option. As time goes, that option is going to go down in value. Great, we want to be able to buy it back at a lower price. So that means time is positive. But because we receive a premium, that is the most that we can make, regardless how much the stock moves in our desired direction, it is neutral and has a slight directional bias. So if we are selling a short put, we want a bullish movement, but only to the amount of the premium that's paid. Anything more than that, still you're making maximum profit potential, which is great, but you might have been better off doing something that would profit from a sharp movement. Now, I might have confused you with showing you the short call individually and then a covered call, but that's intentional. When we teach multi-leg options, we always teach with a strategy driver. And the strategy driver is the most expensive option within that strategy, always. When you have a covered call, you add a stock attached to it, and that's driving the strategy. Because when you own stock, we want it to go up in value as much as possible, flips your deltas positive, becomes a bullish strategy. Individually, a short call, because you have the obligation to sell and not something bullish attached to it, is bearish, because we don't want that obligation to sell to kick in. And that obligation to sell will kick in when the long call holder says, this makes sense, because they're the driver and you're the passenger if you were short the options. All right, if that one makes sense and we're all clear, let's do 4 in the chat for me. Okay. All right, let's talk about exercise and assignment. So what happens? A lot of times we get this question is, why don't I know that I'm assigned right away? It's a process that happens overnight. And when you get early assignment, or even when it happens over the weekend, I think this is a great chart that gives you an explanation of that process. So remember, the long option holder is the one that owns the execution rights. If they want to exercise their options, it's their decision, not you, the option writer, synonymous with the short option holder. The long option holder, person who purchased that option. So in the case of the call, they say, you know what, I want to buy 100 shares of ABC at $100 per share. They'll submit exercise instructions to their broker, whoever that may be. They may call them up, submit a form. When they submit that to their broker, it goes to the Options Clearing Corp. It's literally called the OCC, is the Options Clearing Corp, and they're responsible for clearing and settling those options transactions. They will then randomly assign a broker. OCC system is random. So that may not be the same one, meaning you're at Fidelity here. This may be E-Trade or wherever, but it's somebody who was on the other side. And then that broker will have the assignment instructions, and then they'll be assigned by their broker. And this auto happens on expiration. If anything is a penny or more in the money through the auto exercise assignment process, unless contrary instructions exist. But this can happen at any time because the driver can do it at any time, but you don't know normally until the next day as someone who is holding the short option. So I think it's interesting and important to know when you're going into your venture of options, how does that process actually work? And this is how. All right. I've got some examples that I don't think I'll go through, but I do love giving these statistics. I will say I need to update these. They're a couple months old, but it still drives the point home. Most people don't exercise their options contracts. 70% of options are traded on the secondary market. Meaning you just buy to open, sell to close, or you sell to open and you buy to close. You do not submit those exercise instructions because normally you can buy to close them or close out those options for at least intrinsic value on the day of expiration. Lots of nuances that are there, especially if they're out of the money, then they're difficult to close. But the point is, exercising isn't a common practice. Only 7% are, and normally it's to capture on a dividend because you are not entitled to those unless you actually own the stock. Done some math, doesn't actually make sense to even do that. However, people do it all the time, so we have to make you aware of it. 23% of options actually expire worthless, but remember, that could be your goal. You'll realize maximum profit potential in the case of short options when they do expire worthless. You do not want them to go up in value. You want them to deplete in value. So that is someone who is making maximum profit. So that's okay. But I think it's great to see the statistics because you may, especially if you're trading options for the first time, you say, oh, do I need to go ahead and exercise these? No, you can close them out on the market for intrinsic value. And normally you want to close them out before expiration so you can sell to close and get back some of that extrinsic value and that time value. When you exercise, you lose all of that time value. All right. I've got some examples of what happens on the day of expiration. I think 2 at a time. I'm actually going to skip that today. And give you some of the best practices. So 1, if you have never traded options today, congratulations. You are on your way and you have taken the correct first step, which is starting with education. Understanding is the key to optimizing trading, meaning especially with options, you're adding a layer of complexity, which is an expiration date of something that expires. So it's going to require you a little more time to manage because time is literally a component you've added to your portfolio. You also have to pay attention to implied volatility, but you have to know the positive and negative factors of options to determine what strategy you want to select, optimal entry points, and optimal exit points. OptionsPlay's tool is designed to give you those starting points of option strategies, to give you the trend and ideas. And then you could say, okay, this is bullish or this is bearish, this is neutral. We'll tell you that. And then you'll have 3 strategies to choose from. We'll give you that optimal one. And then you can compare and contrast, execute from there. So starting with education. Have a sentiment and have a process. Notice when we had that T chart, we had bull and bear. I've talked about moving directionally in your desired direction and also a slight directional bias. So knowing where you feel the underlying security is going to go is extremely important. And it's also important to take the emotion out of investing and have a disciplined approach. And we talk about that and we teach that at OptionsPlay. Use tools and resources. Oh, it says first trade. We'll take that one out. And make sure you have a disciplined exit strategy. Extremely important to maximize results. All right, that is the end. Got it right at 5:03. So we've got about 5 to 10 minutes for questions. So feel free to put them in the chat. I will put the Q&A back up so I can see it. And let me know what you have, what questions you have from here. 2:03 here. Thank you, Chris. I am on Eastern time today. Tony's been working on a complete other time zone, so he's normally at 2 a.m. All right. Yes, you will get a copy of this presentation if you registered for this. You need to sign up for a free trial. Philip has put that in the chat. Thank you, Philip. And you can see that there. And then okay, I need to bring up the platform for that. And that. Robert, that's a great question. Do you get a discount if you are with Fidelity? You can send us an email at info@optionsplay.com and have a chat with us. We get that question quite a bit. When a corporation offers options to employees, do they buy options or use treasury shares? That is normally different. So those employee stock options are different than these type of options that we're talking about. So I would say very, very, very different. But I appreciate that question there. Taxation is different. There's so much that's there. Talk about slides. If I want to sell a put on a stock, but prefer not to get assigned and want my option to expire worthless, is using a low delta a good idea to minimize my chances of getting assigned? Yes, Mark. The lower the delta, the higher the probability of it expiring worthless. But a lower delta means it's further out of the money, so further away from the current strike price or the current market price. Which I think answers the question that Lewis has, is what do you mean with out of the market? Probably said out of the money, which means so in the money means your option has executable value. You have the right to buy ABC at $100 per share. ABC is at 110, that's in the money. If ABC is at 100, that's at the money because my strike price is equivalent to the market price. And it's out of the money if ABC was trading in the market at like $90 per share because the market's more favorable than my option contract. So that means my option contract only has extrinsic value and it's out of the money. And I want it to go up in value as much as possible. So it's got a long way to go. All right. What is the delta? Yes, that is a Greek. I apologize. I tend to spit those out, and especially I gave a presentation out yesterday. But with what you attended today will literally, if you attend a Greek session and rewatch this or understand these, you will understand the Greek so well. The way that we teach options sets you up for laying a very solid foundation. And then you can get advanced very, very quickly because it's those light bulb moments that we honestly were taught in over decades of experience. Felix, how many days do you use to buy a call and what delta do you use? Thanks. So Felix, normally when we pull up the OptionsPlay tool, it's going to default to 60 days. And that is so you optimize the time value component. Because remember, time does move against you, but it's not linear. So it normally starts falling off that cliff 14 to 21 days until expiration, 60 days. And that number comes from back testing over a decade, S&P 500 securities, get asked that quite a bit. 60 days allows you to gain that sharp directional move, not have to overcome that premium that you paid, that extrinsic value, and still be able to sell to close it, keeping that extrinsic value. That's where that number comes from. Delta wise, normally those are about at the money. And that's because something called, I'm trying not to say Greeks, but that's where your acceleration is. Gamma is highest, sometimes slightly in the money, but it's our rule of thumb is risk versus reward. So for long options, first and foremost is never spending more than 2% of your portfolio on one trade. And when you're buying options, you want to make sure you have that 3-to-1 risk reward ratio, meaning if whatever I spend, I want to be able to make at least 3 times as much as I spent. And then you can do the math on that. If you're only using 2% and you lose, your gains are going to astronomically outweigh your losses. And it's so much more difficult to overcome a loss if you use more than 2% of your portfolio. And it's a tasty trade. Tom Sosnoff quote, trade small, trade often. That's where that's derived from as well. Is there a general rule for selling covered calls delta wise? Yes, 0.15 to 0.2. That way you account for capital appreciation. And 45 days until expiration for that one. I'll just give you that answer right out. in doing a credit spread, do you ever run the risk of the short strike being assigned to defend the money? Absolutely, you sure do. When you have a credit spread, you can have a broken wing spread, and you can have where the option may not fall, as in move adversely. So if you've got a bull put spread, for example, so you have a short put, and then you buy your long put, and if it falls, so moves against you, and so your short put is in the money, but it doesn't go all the way down to your long put strike. And this can happen at any time. You may be obligated to buy those shares. That obligation kicks in. You own the shares, and you also still have that long put. But the risk stays the same because you have a predefined obligated buy price, and then you have a predefined sell price. So you could just execute upon the terms. Risk equals exactly the same math. And otherwise, you can adjust, and there's repair strategies. And those are things that we talk about on our strategy-specific deep dives. When is the next class? That is a great question. So I will be doing December. I believe we decided on the Greeks, and I'm going to do a deep dive in basics because that was asked for. Are there any other sessions? You can let me know. I tend to pull these together based on your asks. We're a community-driven company. So if there's specific classes, I see a lot of questions on here for debit and credit spreads, actually. So perhaps we'll add that in. Can you get a 3-to-1 profit ratio on a vertical spread? Absolutely. All right. And yes, David, there is a calendar. I can, let me see if I can grab that and find it for you. Diana, I'm new to options and focusing on long calls and puts. What delta should I preferably look for, and what's the best strategy for a stop loss? So we always, the delta for that one is a 0.5 to a 0.6. You might want to go deeper in the money, ever so slightly. And know that when you're buying options, we look at 60 days till expiration, like I said earlier, to account for that time decay, but you have to have a price target in mind. That's extremely, extremely important. And that 2% roll is also going to help you out astronomically. And then we've got your price target could be from a technical perspective. You see a very clear point of resistance or support, depending if you are a bull or a bear. We have rules of thumbs. When you are at 75% of that gain potential, won't say max gain potential in this case because they're large, 75%, go ahead and close out that option and move on to the next one. And then if you're at 50% of your max loss, which is the amount that you paid, also close out that trade and move on to the next one. For covered calls, it was, yes, 45 days until expiration, or a 0.15 to 0.2 delta. The only time that we vary or deviate from those deltas is if there is a clear resistance zone from a technical perspective, as in, I don't think that stock is going to go above that price. But if it does, that means you still made your max gain potential. So do not fret. Yes, we can do leaps, AG. I like that. That thought there of longer term options. We also could do poor man covered calls as well. One of my very dear friends, first our initials are AG, so don't know if you're her, but you would have said something else. All right. I think we answered most of those. Chula, I see your question on using debit and credit spreads with graphical charts. I'm going to do I'll make sure I include that on one of our sessions because that's good to show a visual on. And let me answer these last two. So Ken, if I sell a cash secured put, will my profit improve as it approaches expiration? Well, that question has two answers. If all else equal, everything remains the same, as in the stock does not move, yes. If the stock does move, could be yes or no, depends on what direction. So if you have a cash secured put, remember you are bullish. Let me go to that T chart. So if it moves up and time is moving in your favor, yes, you're going to be profitable. But if time is moving in your favor and it's moving down, you may not be, because there's other components that are associated with it. Also, if implied volatility moves up, you may also not be profitable. And that's why we sell when implied volatility is high, not buy when it's super, super low, unless you're using cash secured puts to add to your longer term portfolio, in which case you'll end up owning the stock, which was your intent anyways. Vertical spread, Tony uses that word a lot. I tend to not, but it's just another word for an option strategy for two spreads put together. So meaning, or two option contracts creating a spread. So a long call and a short call, vertical to the upside if it's a bull call spread, bear call spread, vertical to the downside. That's what a vertical spread means. It's just you have a directional bias. All right. Do a class on callers. We can do that. Straddles at earnings. Oh, Steven, I like that one. We'll do that one around earnings time. Yes, and you said that, because I also like to bring in iron condors too. Lauren says verticals. Okay, I believe it's optionsplay.com/events. Let me stop sharing. But that's where we would post our calendar of our events that are coming up. Play. No, 404. That was a guess. /network, excuse me. All right. I will pop that into the chat. Oh, and there is Philip saying, we send weekly emails. So if you sign up for our email list, you'll see it there or in the pop-up in the free trial. All right, so I want to make sure I've got this right. We have leaps, straddles and condors, callers, and spreads is what we want more information on. Okay, covered. And butterflies. I would love to do that one. It sounds like an advanced strategy session. Okay, so I will add that in. That'd have to come in February if we're doing that one. Okay, noted. Thank you. All right, well, I'm going to end today's session here. I really appreciate you taking the time to attend the OptionsPlay crash course. We covered a lot today, so if it felt like a lot, know that I took 4 presentations and I condensed it into one, and I took out other components of it that really helps clarify it. So if you feel like you need additional information, next week I am covering I'm going to expand on long calls and long puts. If we have time, I will add spreads to that, maybe even butterflies. Why not build up? So if it didn't make sense, know that I'll definitely spend more time on the basics for that reason. I don't want to have the advance overtake it, but I will show you how you build it and you layer option strategies. And that's the beauty of options. Once you understand it and you have those light bulb moments, you have to know the positive and negative factors that affect your option. And then you can create and structure trades to have an optimal strategy. And then of course, have a disciplined approach. So thank you again. Hope everyone has a wonderful day, and I'll talk to you soon.